So, amongst all of the rapid-fire news of the last month, the USA announced that it wanted to build its own sovereign wealth fund, basically a giant investment account to save and invest public money. Around the world, similar funds are some of the largest and most influential financial entities in the world. Notably, places like Norway, France, China, and the oil-rich Gulf states have national investments accounts with hundreds of billions, if not trillions of dollars invested into companies, real estate, and even things like sports teams all over the world. What's more is that largely these sovereign wealth funds serve a really important purpose and are highly effective at providing a reliable, sustainable source of revenue to run a country with. So the idea that the USA wants to build one of its own, at least on the surface, seems completely reasonable. Despite this, the general consensus from economists, financiers, and general commentators is that this is all just a bit silly. But perhaps that's unfair. Typically, these funds have been used by countries that have large natural resource revenues as a way to save money for the future, and well, the USA is now the largest oil producing country of all time. If there was ever a time to start saving, now would be it. What's more is that sovereign wealth funds don't necessarily need to be the same scale as something like Norway's to be an effective fiscal tool. Scaled up to the size of the US economy, even a much more modest per capita investment would be a significant player in global financial markets. Now, that has all sorts of advantages and disadvantages that are worth seriously addressing. So, how could a US sovereign wealth fund work? What problems will it need to overcome? And perhaps more importantly, what problems will it cause? Now, when it comes to investing, knowing what to buy is only half the battle. Keeping track of everything is just as important, and if you've ever tried juggling multiple broker accounts, dividend payouts, and performance tracking, you'll know it can get complicated. That's why I want to introduce to you Snowball Analytics, a portfolio tracker that actually makes sense. Unlike a lot of other trackers that just show share prices, Snowball factors in everything, your dividends, transactions, and even upcoming payouts, so you always know exactly where you stand. And if you're a dividend investor, you'll love the event calendar that lays out when your next payments are coming in. It also connects automatically to over 150 brokers across the US, UK, Europe, and Asia, so whether you're using a major platform or something more niche, your data is always up to date. For those who would like to compare performance, Snowball even includes a backtest tool to measure your portfolio against benchmarks like the S&P 500, including dividends. So if you want a smarter, clearer way to track your portfolio, check out Snowball Analytics today. It's a tool that actually makes managing investments easier. You can try a 14-day freemium and check out all the opportunities and ideas. In the past, there have been endless cases of countries diverting wealth away for rainy days, wars, or just bad crop yields. In many ways, grain silos and gold reserves could be thought of as the first sovereign wealth funds. However, the concept has been somewhat fine-tuned over the last half-century or so, taking advantage of global trade, global finance, and new levels of global wealth creation to build the modern funds of today. Of course, a lot of this has to do with the fact that, until fairly recently, no country on the planet had been experiencing growth of this magnitude. Really, it wasn't until countries like Kuwait with budding oil industries that nations began experimenting with their newfound excess in domestic cash and strong foreign exchange reserves. But while there are now almost 100 sovereign wealth funds worth as much as 10% of the world's GDP, they scarcely resemble their initial definition. Every country models them differently based on what they wish to achieve through their investments, some great, some bad, and some are straight up confusing. As addressed in several other videos on the channel, Norway is essentially the gold standard when economists think about sovereign wealth funds, taking revenues from its oil and gas wealth and converting that into financial wealth invested into asset markets all over the world. By doing this, Norway is not only saving money for when oil runs out, its revenues are also not determined by the day-to-day price of oil. The wealth fund acts almost like a shock absorber on the oil industry and prevents Dutch disease. Additionally, they've made it so that other local industries avoid just becoming a petrostate because the local economy doesn't actually run that hot with lots of oil wealth crowding everything else out. This is an important distinction to make as countries like the Gulf states might be starting with the same premise, yet their funds lack transparency, and leadership tends to use them as more of a piggy bank with a conveniently respectable label, rather than something solely dedicated to public fiscal security. And although oil and natural resource wealth started this trend, there are a fair number of sovereign wealth funds that aren't necessarily driven by revenue taken from natural resources. My own home of Australia has the Future Fund, which was actually funded from the sale of public companies back in the early 2000s. We really ought to have built our own resource-funded system, but that's a discussion for another day. What's making headlines this year is the US, and its plan for a sovereign wealth fund of its own, which has come under some intense scrutiny. Sure, some states, most notably Alaska, have their own funds, but this seems like odd timing to humour such a goal at a federal level. Mainly because, as economically influential as the whole country is, the government is missing the wealth part to create a sovereign wealth fund. At the moment, the United States is producing a lot of oil, amounting to around 827.1 million metric tonnes in 2023 alone, and under the current administration, this is expected to expand dramatically. But it doesn't tax it nearly as effectively as somewhere like Norway. In fact, the US government actually spends a lot of money subsidising the industry. For example, the intangible drilling cost deduction allows companies to deduct a majority of the cost incurred from drilling new wells domestically. Sure, this might encourage growth in the industry, at least theoretically. However, it's estimated this will deprive the government of $13 billion in tax revenue over the next decade. There are also indirect subsidies like the foreign tax credit. When American companies operate overseas and pay royalties, they usually deduct these payments from their income to lower their tax back home, yet for oil and gas companies, instead of just deducting these royalties, they can treat them as if they're paying foreign taxes, which gives them a bigger tax break. If this weren't in place, the government could collect an additional $12.7 billion in the same time span. And a lot of this is due to a difference in how these industries operate in comparison to many other countries across the world. Oil and most natural resources in places like Norway, Saudi Arabia, and even Canada belong to the government, but in the freedom-loving USA, they belong to whoever owns the land. This means that they have to incentivise drilling in ways that aren't nearly as profitable for the government itself. There are various natural resource rents and fees charged to companies drilling on public land and in the oceans, but it's extremely minimal, and at a federal level it's mixed in with miscellaneous revenues. Of course, this doesn't rule out the plan entirely, it just means the government is going to need to find that wealth somewhere else. If the US really wanted to start a fund, it could effectively just allocate government money into building up a fund every year on top of its spending. But again, the glaring concern here is that, well, the country already spends far more than it makes. Sovereign wealth funds, conventionally speaking, is something that a country does when they've achieved a budget surplus. With controversial programs like Doge, such immediate actions don't really lend a hand to creating a fund directly out of pocket. This project in particular is on its way to conducting things like large-scale layoffs, most of which will involve buyouts, in an effort to rein in government spending, which is causing the country to take on seemingly unsustainable amounts of debt. Now, this needs a whole separate video to cover properly, and it's changing so quickly that covering it comprehensively is almost impossible. But the point here is, this has been a very disruptive program, and even if it was entirely necessary, it doesn't make much sense to do all of this to cut down spending, just to allocate more spending to building up the sovereign wealth fund. And government expenses are just one side of this fiscal coin. Estimates vary, however, a current move to extend the 2017 tax provisions could lead to a $4.2 trillion loss over the next decade. In fact, in total, the government could lose $5 to $11 trillion in revenue over the next decade if the administration's full tax plan, including extensions and new tax cuts, is enacted. And all of this is to say that if the government is taking drastic action to slash expenses and is expecting to receive less income, it's probably not the right time to start thinking about how to invest. That's like someone who's about to take a pay cut, already living on packet ramen, opening up an investment account. But, technically speaking, the US could still make it work, it's just that it wouldn't resemble the sovereign wealth funds based on the initial criteria, and this has to do with something that helped the country secure its actual existence over 200 years ago: good credit. The US can borrow money cheaper than basically any other institution in the world. Sure, debt is still piling up at an alarming rate, however, the country has never defaulted on its sovereign debt in its modern history. Even despite this almost legendary reputation, their credit rating has taken some hits, sliding from AAA to AA+, mainly because the government insists on shutting itself down from time to time. It's a very strange ritual. But anyway, the US federal debt still stands as somewhat of a financial foundation for risk-free returns. As it stands today, the current US Treasury rates are around 4.3 to 4.7%, while the long-term expected market return is generally between 7% and 12%, meaning the government could effectively borrow money and profit off the difference in returns. Now, this all sounds almost reasonable. The only issue is that doing something like this is incredibly risky. If the value of the stock market were to crash, this debt would still need to be paid back, just like any leveraged position, and worst case scenario, this could seriously undermine US currency and/or debt stability. At this point, it would be less of a sovereign wealth fund and more of a sovereign leveraged investment fund. But that still may not be a deal breaker. There's also a matter of scale. The United States of America is a massive country with an economy so large that most other countries on the planet have a vested interest in its survival. To put it into perspective, Norway now has more than $2 trillion invested, making it the largest sovereign wealth fund in the world, but it has a tiny population of about 6 million people, which is less than what's seen in the average US state. To meaningfully move the needle on fiscal concerns, even slightly, the country will need a lot more than that. And it's hard to deploy this much capital without moving the markets. Investing that much money, unless it's done over decades, would overwhelm global financial markets and just push prices up, making it hard to actually secure value within the fund. It would, however, be great for existing asset owners, and not to be too cynical, that might be the whole point. But putting these reasonable suspicions aside for a moment, borrowing money cheaply to reinvest into a lot of different companies in order to create a sovereign wealth fund large enough to help US citizens is not only a massive undertaking, it has the potential to undermine a competitive business environment by picking winners and losers for investment. Even a relatively modest sovereign wealth fund compared to the size of the US economy would end up owning a significant stake in a lot of public companies. This raises questions about how these shares would be used to vote on corporate decisions and what companies get investment in the first place. Norway gets around this by intentionally omitting investments in their own market. Although, to be fair, not being able to invest in the Norwegian stock market isn't exactly crippling. But for the US, not being able to invest in their own market would make the problem of scale even harder, since asset markets in the US are such a significant share of all global activity. Of course, a lot of this investment could go into foreign companies, but that raises other issues like how governments will react to having their major domestic businesses owned largely by the US government. Now, with all of the issues that the US could face down the line, this presents an additional question. Why would the US want to set up a sovereign wealth fund in the first place? Countries like the UK are considering it too, and neither of them has the excess to create a fund the traditional and safe way. Well, there are 4 reasons that make the most sense. The first is geopolitical posturing, aka our rivals have it, so why don't we? The China Investment Corporation, or the CIC, is the second largest in the world at around $1.3 trillion in assets. It's obviously structurally different from what's seen in Norway, primarily funded through China's foreign exchange reserves accumulated through trade surpluses. It's also insanely disorganised with all of the country's bureaucratic handicaps. However, it's become a bit of a bragging tool, something that the current US administration would undoubtedly love to change. The second is intrinsically linked to the first. It's just bragging in another form, propping up assets to show how well the economy is doing, and this is an incentive that no country is above. Norway does it with their annual reports and disclosures showing their top holdings like Apple, Microsoft, and New York real estate. China does it as a soft power move, and Qatar does it by advertising its ownership of the London Shard and Harrods. But this one is a tad silly. The US government seems very interested in using a new sovereign wealth fund to flex its economic standing through assets, but this promotion is likely to have adverse effects due to the fact that the US, and the UK for that matter, possess more liabilities than they do assets, along with another reality that not much of this collection of assets is actually liquid. There's also the domestic element here regarding the US, and this is how it affects the polls. The current administration might only have 4 more years before it's replaced, but the end goal for either party is to prolong their agenda as much as possible, and sovereign wealth funds can help the brand on the campaign trail. And the fourth is something that sovereign wealth funds could technically do if the next campaign fails: insulate investments from political changes. Countries like France have non-traditional funds managing investments into things like green energy infrastructure and entrepreneurship, long-term projects managed by a public institution that will most likely remain untouched after government leadership changes. This one's tricky because, at least currently, the US executive branch appears to want full control of investments. There's really nothing standing in the way of a succeeding leadership changing everything if and when they're replaced. Now, nobody can predict the future, least of all economists. But if you will indulge me just this once, this may very well get funded, but if it does, it probably won't be scaled to any meaningful levels. It will manage a few $100 billion, maybe make some strategic investments, maybe pump a few friendly company stock prices, be called a win in a few press releases, and then largely be forgotten about. A sovereign wealth fund is a very useful tool that can genuinely help a lot of economies, but the thing is, there is a correct tool for every job, and in the USA's current economic position, a sovereign wealth fund is a bit like a mallet when what the economy really needs is a scalpel. It's not a totally useless idea, it's just not the right tool right now. We made an entire video last year on how, without very strict oversight, these funds can just be squandered on dumb projects, something that's playing out today with the oil-rich Gulf states. If the USA does actually go ahead, it could probably learn a lot from these weaknesses, and you should be able to click to that video on your screen now. Thanks for watching, mate. Bye.